Hi, I'm Sarah Benwell, editor of InsuranceInvestor.com, and I'm here with Patrick Sainer, head of macro strategy at the SwissRe Institute. Patrick is speaking at our Insurance Asset Management Summit later in November, so I wanted to catch up with him to have a little bit of a chat about what he's going to be talking about there. Good afternoon, Patrick.
Hi, Sarah. Good to see you.
You too. So my first question is, what challenges lie ahead for insurance asset managers as we emerge from the coronavirus crisis?
So some challenges have not changed, but if anything, just accelerated as a result of the COVID crisis. So for example, the economic environment of advanced economies over the past few years was characterized by low growth and low interest rates. And this picture is unlikely to change anytime soon, with the recovery from COVID being quite protracted in our view. So this lower for longer interest rate environment just means that the search for yield will continue for quite some time.
Great. So how might the industry have to adapt and change for the longer term future, bearing all that in mind?
Well, Japan's experience with the low growth and low yield environment is actually a very useful comparison for the insurance industry as it went through this backdrop for the last 2 decades. And our findings, particularly for the Japanese life insurance industry, are really threefold. So first, on the asset side, insurers really increased their allocation to riskier investments in the search for higher yields. So this includes more exposure to foreign government bonds as well as illiquid assets. Second, and on the liability side, the insurer's product mix also changed quite a bit. So for example, insurers switched to unit-linked products to reduce their investment risk. They started shifting to higher margin health insurance products and also just simply charged higher prices. And third, the life insurance industry also changed its structure. So, for example, we saw quite a bit of more overseas expansion, but definitely also more domestic market consolidation. Now, when we look at Europe, the situation in some countries is actually already quite delicate. So life insurers in Germany, for example, have a duration gap of 10 years and a guaranteed return mismatch of 3 percentage points, which is just amazing. So this is clearly an unsustainable situation, and we'll likely see some companies undertake similar actions to what we observed in Japan over the past 2 decades.
That makes perfect sense. And how important do you think resilience is, and how has our attitude to resilience and fragilities evolved?
So it's clear that economic resilience is now more important than ever. So our analysis actually on economic resilience, together with the London School of Economics, showed that global economies entered the COVID-19 crisis with less capacity to absorb shocks than they did prior to the global financial crisis. Now, still, unprecedented policy actions across all major economies helped to cushion the blow somewhat when it mattered most. So, for example, the fiscal and monetary policy stimulus announced across the US and European economies during the pandemic really exceeds the size of all bailouts over the last 50 years combined. So just unbelievable numbers that we're witnessing. But it's also clear that the COVID-19 shock has also increased risk awareness. So as we're using much of those economic buffers, the key focus now should be on strengthening economic resilience and addressing these fragilities going forward. And we're convinced that countries with higher economic resilience will emerge from the crisis with a stronger recovery.
Perfect. Thank you so much, Patrick. I look forward to hearing more from you in November.
Excellent. Look forward to seeing you there.